In this video, we're going to talk about what interest rates are. You hear a lot about interest rates in the news, and especially in news related to business and the economy. So, hopefully, by the end of this video and this module, you'll have a much clearer idea of why people talk about interest rates so much. In my opinion, there are actually two prices that really matter when it comes to the global economy. One of them is the cost of capital, which are interest rates, and the other is the cost of energy, uh, prices for things like oil. Those two things, in my opinion, my personal opinion, are the most important factors in the global economy. So let's talk about one of those two now, which are interest rates. So you can think of interest rates as a type of rent. Okay, so just like when you rent an apartment, you are paying the landlord rent every month for the right to use their property. So interest rates are the same. Conceptually, they're very similar in that you, if you're borrowing money, you're going to be like the tenant, basically. You're going to be using the money from a lender. Okay, so the lender is like the landlord of the money. The borrower, are like the renter. And so you're going to pay the lender uh, a certain rate for the privilege of using their money. And this rate is called interest. Okay, so it's basically the price that a borrower is going to pay for the right to use money. And just like rents change for housing, the interest rate also changes, and it changes based on many factors. Interest rates are different all around the world. The interest rate in the United States is going to be different than the interest rate in Sweden. It's going to be different than the interest rate in India. Um, so let's just talk about the system in the United States. Uh, the Maybe the most important factor in the setting of interest rates is government policy. Okay, so we have the Federal Reserve Bank, which is basically the institution that controls the supply of money, the supply of US dollars, essentially. We're going to talk more about the Federal Reserve later in this module, but basically, the actions of the Federal Reserve and their policies are the basis upon which interest rates kind of are set. Okay, they're going to set uh, one rate, a short-term rate, and then based on that rate, everything else, all the interest rates that kind of um, exist are going to be built off of that. Because just like housing, renting a studio apartment, the rent is going to be different than renting a house, is going to be different than renting an office space, etc. There are different interest rates for different types of things. Okay, so you're going to have interest rates for how much the government borrows for. Your credit card interest rate is going to be different because you are more risky to lend to than lending to the government. So the interest rate is going to vary based on the situation and who is borrowing. But really, they're all anchored to uh, the rates that are set by the Federal Reserve. That's kind of the starting point, and then everything builds out off of that. Um, so the Federal Reserve is kind of the starting point, and what they do with the raising or lowering interest rates will affect all the interest rates for everything else going off of that, because it's kind of the seed upon which everything else kind of is based on. Interest rates are also affected by economic conditions. So during recessions, there's going to be less economic activity. The demand for funds is going to be lower. So the economic conditions are also going to affect uh, the kind of supply and demand for money. The economic conditions are also going to change the Federal Reserve's policies. Okay, so it's kind of chicken and the egg, which one is kind of the causal factor, because when there's recessions, the Federal Reserve will do certain things with the money supply and change their policy. So they're kind of related, these first two. And then just supply and demand factors in the banking system and capital markets. So uh, the supply and demand of capital changes just based on just who is providing the money. Just like um, with the housing market, if there's more landlords that are putting their properties for rent, it's gonna cause more supply and it's going to lower the asking rents because there will be competition. If there's a lot of people moving to a city, for example, just to keep this analogy going, that's going to raise rents because there's more demand for housing. In the same way, that there are supply and demand factors in the capital markets and kind of how money is lent and borrowed that's going to affect the interest rates. These factors are very complicated. I would say maybe beyond the scope of this class, but it's just like any other market. The supply for, or sorry, the market for capital, it's affected by supply and demand. Okay, so just some terminology. There are different uh, when people talk about interest rates. Uh, there's certain uh, terminology we can kind of clarify here. So the nominal interest rate is the stated interest rate. So if some bank said, "Hey, I'm going to pay you 5% interest for you opening a savings account at my bank," okay, that is the nominal interest rate. That's this the high level. If you put in $100 and it's a 5% interest rate, they're going to pay you $5 a year. Okay. Now, there's one important factor missing in this, which is the inflation rate here, because the interest rate is, they're going to pay you 5%, but inflation is another factor to determine whether this 5% is a kind of if it's advantageous or not. So what is inflation? So if you were to try to buy a candy bar in, let's call it, not even that long ago, 1970. Okay. So that's approximately 50 years ago. A Hershey's bar in 1970 cost 10 cents. Okay. A similar sized Hershey's candy bar now costs $1.40. So what's happened? The candy bar is the same size and is the same brand and all that. Why is it so much more now? This phenomenon of the loss of purchase power for the dollar or any currency is called inflation. Okay, you're getting the same item, but the the sticker price is much higher now than it was in 1970. And so what has happened basically is that you may have the same amount of actual stuff that's going around. The amount of candy that exists is the same, but now there's just more dollars chasing that same supply of stuff. So in order to compensate, so just imagine, let's say we just injected $1 million into every American's bank account just right now, automatically. If you had $100 in your checking account, now you have $1,100,000. Okay, if you did that to everybody, would the price of everything stay the same? No, because the supply of money, the amount of cash that people have has gone up a lot. And so people will just start bidding up the price of things because the amount of things hasn't really changed. You're going to have the same number of houses, you're going to have the same number of kind of automobiles being produced relatively. You're going to have the same number of MacBooks, so the amount of actual stuff is going to be the same, but now everyone has more of these pieces of paper called dollars. And so the price of everything is going to change accordingly. So that's kind of what inflation is. And so inflation is very complicated to kind of trace because it depends on, yes, how much money is being produced by the Federal Reserve, but it also depends on how much of that money is actually reaching the hands of consumers. So during the 2008 financial crisis, for example, the Federal Reserve created a lot of money, but it stayed in the banking sector because the banks were under a lot of stress. So that money that the Federal Reserve created, kind of, you could say printed, didn't really reach the hands of people. But then you can look at what happened during COVID when the government gave individuals a bunch of money just in their checking account. They sent stimulus payments, unemployment checks. The inflation rate increased a lot because now people actually had more money in their hands to spend, and the amount of stuff didn't necessarily increase. So then the nominal price of things increased. So basically, you have to see what the inflation rate is, because if the inflation rate in this example with the 5%, if your inflation rate was, let's say, 7% inflation, okay, then this 5% is not going to even keep up with the decline in purchasing power of your $100. Okay, so in order to just keep this $100 to be able to buy the same amount of stuff, in 1 year you'll need $107. Okay, because the inflation rate is 7%. So this is what the real interest rate is trying to capture. So basically, you're taking the nominal minus inflation equals the real. Okay, so in this case where we had 7% inflation and a 5% nominal rate, we're actually going to have a negative 2% real interest rate. So that means you're losing purchasing power. When you have a negative real interest rate, that means that the amount of interest that you're earning lending is not keeping up with inflation, and you're losing purchasing power. Okay, so um, if you're a saver, you want a positive real interest rate because you want to not only get compensated for the loss of purchasing power that is happening because of inflation, you also want to earn a return on your investment. So if you're getting, if you're not even covering inflation, then it's not going to be worth it to save. You're better off just spending the money on something, getting something now, because you're going to be losing value for your savings. Okay, so this is why real interest rates are important to kind of keep track of and not just look at the nominal interest rate. Okay, so here is a graph that is showing the historical basically the interest rates in America going back to 1790. So this is 1790 and it's going to 2015. Okay, so you can see that the interest rates have varied a lot. This interest rate again. I mentioned that there's different interest rates for who the borrower is, right? So you as a consumer, you're going to be paying a higher interest rate than the U.S. government pays to borrow. Okay, because the government borrows just like you borrow to buy a house. The government borrows money from uh, all sorts of sources, including its own people, in the forms of like savings accounts. Basically, when you put your money in a bank, the bank may buy U.S. Treasuries, which is basically a loan to the U.S. government. So, so this rate is the rate in this graph is basically the cost of borrowing for the government. Okay, and the cost of borrowing for the government is kind of a benchmark because it's considered risk free. If the government needed to, it could just kind of create more money and pay off its debt. So you'll always receive, if you're lending $100 to the government, you're almost assured to get $100 back. Now, will that $100 you get back be worth the same as the $100 you put in? Not necessarily, because we just talked about inflation, right? So if the government just prints a bunch of money to pay you back your $100, that $100 is not going to have the same purchasing power as it did when you first lent it. Okay, so this is the danger um, with lending in general, because your inflation kind of is eroding the value of that dollar over time. But nevertheless, let's look at kind of the trends here. So you can see that the range, the peak was here in 1981. During this time, the Federal Reserve raised interest rates a lot. The inflation was very bad in this era, And basically, a countermeasure to high inflation is to raise the interest rates. Okay. Um, and we'll talk about that a little more, just kind of what effects interest rates have on the economy. But during this time, the inflation was very high, so to kind of counteract that, the Federal Reserve raised interest rates a lot, which caused even the government, which is risk-free, it caused their rate of borrowing to be very high. You can see during the lows, you can see, let's see, what was going on here. This was basically during a world war. Um, Economic activity was very low. Like it's not like people were out buying a lot of new stuff. The country was really dedicated to the war effort. And so the Federal Reserve policy, well, actually during this time, we were still on the gold standard, so it was a little more complicated. But this was probably just due to the fact that there was all the economic activity was basically devoted to the war effort. Okay. Um, you can see here during this whole period of the war, interest rates were low. During this period of time, something very important happened. Before this time, the US dollar was backed by gold, meaning that uh, theoretically, you could take your dollar and go and exchange it for some amount of gold that was kind of fixed. Okay. Uh, in the 70s, the government had kind of created so much new money that this this pegging to gold was no longer sustainable. Okay. In the 70s, the government basically said, we're going to get rid of the system of tying our dollar to gold, and we can just now it's just paper. We'll be able to create more as we wish. So this was a big change in kind of the monetary system of our country, and it's led to you could argue a lot of economic growth because from the 70s onwards, America experienced a lot of economic growth, but it's also potentially uh, gonna be the downfall of the dollar because if you give the government unlimited ability to print money, historically that's led to the collapse of currencies because the government just can't regulate itself with its spending and it just keeps creating more money until the market no longer trusts the government to kind of maintain a reasonable money supply, and then the currency kind of collapsed. This is what happened to Germany after World War One. um, they experienced hyperinflation. Of course, America is a very, very large economy. We're the largest economy in the world. So we have just a natural buffer against hyperinflation just because we produce so much goods and services that like our dollars are basically backed by this massive kind of economic output. But uh, if you look at the amount of government debt that's kind of happened since the 70s. It's ballooned greatly, and at some point, um, the bill is going to come due. So uh, there's been this policy change. It's still to be seen. Okay, it's only been 50 years. That's a short amount of time for the kind of history of a country and a society. So let's see what happens. The history of interest rates is very complicated. I certainly don't know all the details, but this graph is just worth looking at to see kind of all the different periods of time, all the panics, all the wars that the country's gone through, and how interest rates have kind of been affected. If you really wanted to get into the weeds, I'm sure there are many, many books written on this topic that you could read about and see exactly why interest rates did what they did in those particular periods of time. But in any case, this rate is very important and um, can sink a country. You know, there are some countries that their interest rates are so high to borrow that they can't really function as a government. So Um, these rates can literally sink entire countries. Okay, so it's worth paying attention to. It's worth at least knowing high level uh, what the interest rate is and kind of how it affects the economy. And we're going to talk more about the specifics of how interest rates uh, affect the economy directly in the next video.